Welcome back to the Owner Seat, the show for real operators who want clarity, not chaos. Today, we're getting into the part of the fitness business most owners avoid until it's painful, the numbers that actually run your life. Cash flow, payroll drift, profit leaks, retention, and whether you can pay yourself consistently without crossing your fingers. My guest today is Paul Roch. Paul is a CPA who helps online fitness coaches and boutique fitness studio owners translate financials into simple language, build cash flow clarity, implement clean processes, and grow in a sustainable way with less stress and more control. What makes Paul different is he's not just a finance guy. He's also an operator inside complex systems, currently serving as the executive director of academic affairs and business operations at the University of Houston's College of Global Hospitality Leadership. And he spent years overseeing budgets, financial operations, human resources, and large-scale reporting and planning. So today, it's going to be ultra practical, no fluff, no hype. We'll jump into why profit leaks are quietly destroying owner confidence, how payroll drifts without anyone noticing, the 5 numbers that predict profit, and how to build a 13-week cash flow forecast that gives you your peace back. Paul, welcome to the Owner Seat. Such a pleasure.
Thank you for having me, Albert. I'm looking forward to our conversation today and helping some studio owners out.
Love it. Yes. And that's what you've been up to. Obviously, we play in a similar field in a couple different ways, which we'll go over today. But man, I've been following you. I love your LinkedIn posts. It's not just where you're trying to pitch or put out some random stuff. I mean, you're giving some gems out there. I'm like, this guy's doing this for free. I'm like, there's so much good stuff in here. Shoot, I'm even taking notes. I'm like, I need
Yeah.
some of this stuff. So good. So, I
Well,
wanted to start there. I wanted to start there around, you actually posted something recently that really caught my attention. You talk a lot about calm, clear, and confident, which I speak to many business owners, franchisees, franchisors who want that in their life. So my question for you is, what's the real root cause of what you like to call financial anxiety for studio owners? Is that a lack of profit, a lack of visibility? What is it?
all too often it's that lack of visibility. It's
Mm,
not necessarily they're not being profitable. So I see this both with studio owners and in my work at the University of Houston. Leaders don't panic because their numbers are bad. They panic because they don't know what's coming next. They don't have
right.
any insight into the future. A lot of accounting is, retroactive. The reporting is like what happened in the past, which is not necessarily predictive of the future. But, I've worked with payroll or studio profitable owners who feel anxious every payroll cycle because they're guessing. And I've worked with owners who aren't wildly profitable yet, but really feel calm because they have that clarity. They know what their numbers are telling them. They know what those numbers mean. And so calm comes from knowing, and then really profit follows after that. So
Yeah, that's spot on. I hear that a lot as well, is just this lack of visibility. I lift up the hood and there's really not a lot of answers to the questions that I'm asking. And that's kind of your first red flag, right? There's
yeah, yeah.
smoke coming out of whatever. What do
Right.
you do you see owners doing that keeps them stuck in this? You probably see this a lot too. It's kind of this like bank balance decision making process. There's really no strategic decision making when coming up with what we should do next. It's kind of like I look at my checking account, I look at my P&L and scratch my head for a little bit. I'm like, well, we might as well go this way. Do you see the same thing? Like, what do you think's up with that?
Oh yeah. Yeah. So I think you hit on the two main points. So looking at their cash balance in their checking account, saying, "Hey, I got money today, I can afford that, right?" And or really looking at their P&L and saying, what do these numbers mean? I have
Yeah.
no idea what so, you know, using kind of that banking account as a decision tool rather than a
Mm,
reporting tool, saying, "Hey,
mm,
this is what I've taken in so far, and where my expenditures are." So, and then I've seen leaders with large budgets fall into this trap. When they make decisions, based upon what today's balance is instead of a forward plan,
mm.
everything really becomes reactive. And so when you're living in that reactive state, a lot of bad decisions come from there, right? And so then studio owners feel relief when the cash is up and well, it's all good, right? Money's coming in, money's flowing.
Right.
But panic really when it dips. So the problem is the bank balance only tells you what happened, like we said. But leadership really starts when you are able to separate the past activity from the future reality.
That's so spot on. I'm curious why. I mean, what are your thoughts on why that is? I kind of have some thoughts around this like reactive. Maybe it's just like that basic accounting class everyone took versus I don't think anyone really stepped into what does scenario based planning look like or forecasting. Is it the education system or is it I don't know, accountants might kill me. And you're a CPA, by the way.
Yeah,
You're a CPA that's thinking that has the education from the accounting piece, right? Which you then use
yeah.
to go and do FP&A. A lot of people don't do it. Is it because it's harder? Is it just require more work? What do you think?
You hit on several points. I think some people, it's like one, they started the business not to do their books, right? They started because of a love of working with people, seeing those transformative changes. Going taking from client A from here they were and now here they are. See, look at the
Mm,
success story, and that's really what they love.
yeah,
That those client transformations, and not so much the bookkeeping or the numbers. There's a lot of fear and anxiety that people have when starting the business, right? Because most of the people, the studio owners, didn't go to business school. They might have taken an accounting class. They might not
mhm,
have. They might not have even gone to college. But it's just kind of that lack of a partner with them. So they might have a bookkeeper. They might be doing it on their own. They might be doing it through QuickBooks. QuickBooks has, simplified a lot of things, but at the same time, if you don't know what you're putting in, you're going to get really garbage out.
yeah.
So yeah, it's just kind of it's a combination of all of those factors going, okay, so what do I do? And then they don't have a partner who's willing to sit down with them and map out what their expenses are, what their revenue is, what their memberships are. Is like, okay, so in being proactive rather than that reactive. I believe early in translating the numbers into clear actionable steps and in plain English, right? So
Mm,
no accountant speak. And so that's
I love
kind
it.
of my philosophy.
No accountants. I love it. So, what do you think is the most common story owners tell themselves from your experience that is for sure flat out wrong? And it's probably costing them margin. I mean, who knows what else it's costing them, but
Right, right.
what do you hear a lot of like what are some of the things, including right? Or when owners say, hey, my numbers confuse me, what are they what's the misconception? What's wrong and what are they actually afraid of?
So I would guess that the number one thing that I hear is I'll deal with this once things calm down. Well, you know what? Things never calm down on their own. There's always another fire to be put out. So I see this not only in large organizations at U of H, but also in small businesses. So that clarity creates the calm, which and then waiting costs money, right? And
Mhm.
so it's like you could have, bought some new equipment, but with, at the end of the year to maybe save some money on taxes, but you didn't know what you had in your bank balance. So to make those decisions and you're like, okay, what do I do? And like I said, that waiting that costs money, but it also costs confidence because then so many studio owners are going, okay, I don't know what these numbers mean. Therefore, I'm going to put it off to next month. And then next month comes and I still don't know what they mean. And I'm going to put it off again. It's just it never calms down enough to where you think you're going to have to carve out time to take care of that stuff without
Right.
intentionally sitting down and doing it or partnering with somebody to kind of be a thought partner to take that stress away from you.
Well, when people reach out to you and you're coaching them, mentoring them, partnering up with them, what do you recommend? Like, what are the three habits that change an owner's relationship with money pretty quickly after they spend
Yeah.
time with you?
So first would be just kind of a simply weekly cash check-in that looks forward. So
Yeah.
looking at, it doesn't have to be complicated. Second, separating owner pay from leftover cash. So being intentional about
Whoa.
paying yourself as the owner. You're working your butt off at these studios and in your business. You deserve to be paid.
Yeah.
Paid first and not paid last, right?
Love it.
Third, viewing expenses monthly with curiosity instead of shame. And so I tell people all the time that, hey, this is a judgment-free zone. These calls, there's no judgment going on here. Now, can we do some things better? Yeah. but am I going to shame you because you don't have all of your stuff together? It's because you don't understand these numbers?
Yeah.
No, because that just shuts people down, right? And so those three habits really move owners from survival to leadership.
Yeah, that's so good. So just to repeat those and tell me if I missed it, but looking at having a cash review each week, right? And
Hmm.
I mentioned at the top of it or a 13-week cash flow forecast, which you promote, and I can't wait to chat about that. The second one, yeah, I feel like people skip that first one the most, especially owners, and they go into
Hmm.
distribution mode, but it's kind of like the wild, wild west. It's like, I'm just taking this much out with no rhyme or reason, right?
Right.
Maybe because the holidays are coming up or something, but it's
Yeah.
not really a strategic thing. And you kind of let
Hmm.
your business suffer because of it with not even knowing that you're doing it because you're not doing step one. And then I laugh because step three, I'm telling you, it's one of the first things I go do, whether it's QBO or Sage or whatever, I'm pulling all the different reports and I call it the keep, kill, discretionary, 'cause, every now and then there's
Hmm.
some personal items coming in there or renegotiate terms. And you should just see the faces like, really, we're going to do this? I'm like, absolutely. Like, maybe not one of my favorite parts of this, but trust me, all is up from here once we go through every
Yeah.
single line item. But it's needed,
Yeah.
right? It's needed. So those three habits are huge.
Yeah. I mean, you could be
Agree.
paying for four different subscriptions that do the same thing,
Right.
and you didn't even know. It's like,
Yeah,
oh,
no idea. Yeah.
I remembered about signing up for that 3 years ago. I meant to cancel that, and I thought I did, but oh, I guess I've been paying for it. So it's like,
Yeah.
okay, well, even those $25 subscriptions add up over time. That's it's what, $400 a year, and so it's
Sure.
like, $300 a year. But yeah, and if you have multiple studios that are doing that or multiple
Exactly.
subscriptions, it just balloons, right?
I was just doing this activity last week, and most of the answers to my question on what is this? Do we need it? It was, I don't even know what that is. And here's the deal. I'm
Right.
not saying every owner needs to know every little thing, but these are cash makes or breaks your organization.
Exactly.
It can be the reason why you fail or succeed. It can be the reason why you meet payroll or you don't, right? And so it was one of those things in so many different ways, right? I did it politely, but it's like no one's going to care about this more than you, the owner, right?
Right.
So we need to
Exactly.
know. Let's find out what it is. And if we don't need to pay for it, let's stop paying for it.
Right.
So interesting,
Or yeah, or there's maybe a service that bundles like four of those things now that didn't exist 5 years ago, right? And it's like,
right?
well, and now it's cheaper. And so
I love it. Yeah. Well, let's switch gears into profit leaks. I think as I think about the future, definitely, turn the corner into 2026. I really think it's good for studios in the wellness and fitness space. It's going to be the year of retention as well as protecting your margins, the unit economics and your margins.
yeah.
So when you promote profit leak a lot on LinkedIn, I'm like, oh man, he's right on it. So how do you define profit leaks in the simplest, as you say,
Yeah.
non-accounting verbiage?
Right. So I think we just really talked about them, but it's a profit leak is money leaving the business without creating some type of proportional value.
I love
Really,
it.
it's not always waste. It's just from neglect, or it's like it's a subscription that you've been paying for 3 years. He's like, I don't even know what that does anymore. We've moved all we've actually that software was used like 3 iterations ago, and so it's like we're still paying for that. So
Mhm.
which those things kill. That's an expense where you could be maybe paying yourself a little bit more or giving your instructors a raise, and so
Yeah. I like that you do that too. And actually it made me think about something and I need to pivot a little bit on my end where you're asking, does this actually generate value? So you brought up software subscriptions or what about contractors? What about marketing, which that one's one of my favorite ones, right? As you start what is this actually doing? Like, is this generating a dollar? Is this generating a new client? Right? What's the and I love the deer in the head. Speaking of, I get the deer in the headlight looks for expensive, but then when I say what's the customer acquisition cost, and I start talking to people for marketing, it's just like, who is this guy? I have no.
right. You're like, what do you mean by customer
Yeah, yeah.
acquisition? I mean, what? Or you start talking about what's
We're just
your
having
lifetime?
fun. We're just
Right.
having fun. helps
Right,
you.
we're just doing some workouts, right?
Yeah.
Or if you start talking about what's your lifetime value of your client?
Is that a membership tier?
Is that so? What do you mean by that? And I've actually
No,
put
going.
together a marketing spreadsheet which I calculate some of those numbers for
That's
you
good.
for
Yeah,
people.
that's so needed for those in marketing. If you're not looking at that pipeline and that ROI, right, the return on investment there, and you don't know your customer acquisition cost or the lifetime value in months and dollars, there's something off. You got to jump in there. But even payroll headcount, like what's the value being generated here? Processing fee or whatever, right? There can be multiple
Right.
different
Yeah.
line items, but as you mentioned, all leading to some type of profit leak or
Yeah.
straining out your margins and you're giving up points. But what's your process for auditing, let's say the last 60 to 90 days of expenses? So it's fast and shoot, not like mine. Sometimes I get a little overwhelming.
Yeah, no, I like that those three categories you described earlier, the keep, kill, and discretionary
Yeah.
or the renegotiate. It's just I mean, it's simple like that. So you pull your last 6 months of your profit loss detail and just alphabetize it or, you
Mhm.
know, say, hey, this what did we do we know what this is for? Is this actually creating value for us? So do we need to keep it? Do we need to keep it to run the business? If we killed it, is anybody going to notice in 3 months that we killed this? If they don't,
Mm.
then we can probably continue to kill it. Or,
Right.
is it discretionary? Do we need this to run the business? Is there a better option out there now, where we could, either transfer the service over to something or renegotiate a rate that we have? So
Right.
there might be a better plan, or take advantage of these sales or the annual buying. A lot of the companies right now are, if you pay us 12 months in advance, we're going to give you a 20% discount on your
Hmm.
services, right? So
Love that.
let's take advantage. If you have the cash available to do that, if you budgeted it, then we can, go ahead and take advantage of that.
And for those listening to another way for renegotiating terms, and Paul, I love what you just mentioned, renegotiating rates. That is huge. You just never know. Sometimes you just need to ask, right? Or if you do something long term prepaid, which also has its benefits when it comes to your P&L and all of that stuff, is renegotiating the actual net terms. Some are 15. I always start with 30, but I'm like, I've seen a lot in the restaurant industry, 15, 30, 60 to 90, because what we'll find, Paul and I, what we'll find when we spend time with different organizations is it's actually not about an outflow. It's the timing of the outflow that's hurting
Hmm. Yep.
your cash cycle. And that's why you're underwater. It's actually not how many dollars are coming out. It's when it's coming out as as a timing of in comparison to your revenue coming in.
Right.
Sometimes it's as little as tweaking that a little bit. It's like, let's push this to 60 versus 30 because your revenue comes in at 45 on average, right?
Right.
And if
Yeah.
you have your expenses coming out at 30, your revenue at 45, you're chasing your tail all year long. And going back to what Paul and I were chatting about, a checking account, my P&L, like I don't get it. It's the timing. It's the
Right.
timing. So now I'm curious on this. I was wondering, when you're working with clients and from your experience, it may not be as easy as what we're saying, right? We have these certain activities,
Right.
it's very practical, it's very analytical, but the reality of it is we're dealing with people, owners,
Hmm.
people, and the emotions. I love that tool. You're
Yeah.
never using it, or you're using 2% of it, yet you're spending hundreds of thousands of dollars a year. I love it. I am not getting rid of it. So how do you deal
Right.
with almost like get into therapy mode in a sense, right? Like how do you
Yeah.
coach them to stop with that type of subjective?
Yeah, it's all about building a relationship with people, right?
Mhm.
So
Yeah.
if you're not just going to come in and be seen as the cost cutting guy,
Mhm.
but if you actually want the business to succeed because it helps you out, right? But it also helps the businesses out. One of my goals, when I started my firm, I want to get away from or help the 20% of businesses that go out, or actually was it 20 or 50% of businesses, small businesses go out of business within their first 5 years, right?
Oh,
So
yeah.
that's a lot of time, energy, capital that people have put into these businesses that it's just kind of, they don't have anything to show for it, right?
Mm.
But the transformations that that our clients are having on people's lives, it's like, okay, that's needed, especially in this day and age where there's so much going on and people are, they're their headspace is all messed up. And so yeah, you're right. Some of these sessions are therapy sessions,
Mhm.
and so some of that's just listening and really understanding what the client's going through and finding a way to say, okay, I totally hear what you're saying, and being analytical, but at the same time being a person, right? We all have those emotions, and some of the times our emotions don't make sense, right? Especially when we're dealing with business. And it's like, oh well, I had this relationship with this guy who got me this software, and then it's gonna hurt his bottom line. Maybe that is, but it's like, okay, how is it also hurting your bottom line by keeping this, unused subscription or something that's like where if we let go of this to move to something else, you're gonna see a better a better business. Your coaches or your instructors are gonna be able to succeed better. Your clients
Mm.
are gonna have even more amazing transformations. Sometimes it's just it is a lot of therapy work.
I like what you
I don't have a psychology degree, but I've worked with a lot of people, a lot of faculty members just going, sometimes they just needed somebody to talk with about
right.
this stuff. But they don't have anyone else to talk with. They could talk with their spouse, but maybe their spouse is tired of hearing about it. I
Exactly.
mean, it's like, okay, so I talked to you about, about this. And it's like, okay,
Yeah.
okay. So
Good.
just a fresh
I
set of
like it.
ears.
I like what you're saying because allowing for the subjective to come out and then kind of what you're doing now is almost like, let's repeat that out loud, right? Almost like this talk back strategy. And it could just, you can navigate the conversation where they realize, wait a second, like that's ridiculous. Why would I keep this? Or what you were saying around, well, doesn't necessarily mean cutting. It's repositioning the dollar,
Right.
head count, investing in something better for your team member base or your member customer base versus something that you're barely using or duplication of cost or what have you. And you had a great example you recently posted about. It was a case study for a specific client where they just kind of took their eyes off the road in a sense and woke up one day and 62% of their revenue was instructor pay.
Yeah.
Right.
Yeah.
And I remember seeing this post. I'm like, oh no, right. Payroll drift is a huge issue,
Yeah.
not necessarily just expenses kind of coming out from everywhere, but payroll is a big piece. And for many of the audience, that's your largest line item. Paul, you see the same thing,
Yeah.
right?
Yeah.
How do you think this payroll drift happens without owners noticing it? Because I'd imagine they're looking at the P&L, but is it they're just not doing that extra math to say, what is that payroll margin as a percent
Yeah.
of revenue? You think that, I mean, it's just taking it to that next level, right?
Yeah, it is. So it's not just one single decision that leads to the payroll bloat. It's those decisions over time, they just compound. So no single decision necessarily feels dangerous. It could be just one extra class here or there, one accommodation. You have to an instructor wants off, so you have to hire somebody else to take those classes. It's one just for now hire. And so I've seen payroll drift happen in large departments and small studios the same way. And then no one reviews that percentage until it's really a problem. You're just saying, okay, yeah, hey, I see my payroll number. Okay, that seems reasonable. Yeah, okay. But then when you break it down into what the percentages are of your studio operations, right? So that's one thing where the P&L, unless you're really doing percentage analysis on it, doesn't tell you a whole thing. So you can see a number, but if you're not comparing that to what your revenue is, you don't realize that there's a problem until there's a problem, right?
That's a good point. And just to go through that again for everyone, as you're going through your income statement, your profit and loss statement, your P&L, every single one of those expense line items, or let's call them the buckets, divided by your revenue, and it's going to give you a percent of revenue, right? The percent that you're spending on that as a function of revenue. And it's your margin, right? So some of the classic things you'll hear is payroll margin or OPEX margin, operating cost margin, or as you get into net income or EBITDA margin, right? You want to know what's the cents on the dollar. So I make a dollar revenue, right? Cents on the dollar you're giving up. Some of us know from those that have managed personal trainers, not every dollar that someone spends on personal training is going down to the bottom line. Typically, it's 30 to 40 cents on the dollar that you're spending on actually giving in commission or whatever you call it to your personal trainer. So you're actually making, let's call it 60 cents on the dollar, right? 60 to 70 cents. So, oh, I'm sorry. Actually, flip that. Oh my goodness. Now I'm confusing myself. No, you're making 30 cents on the dollar. Paul's like, what kind of
Right.
studio are you running? I want that one.
Yeah.
Yeah,
I
no,
want that one. That
it
one's
costs you 60, 70 cents on the dollar. I'm telling you, this post
yeah.
holiday week has been intense, but I think everyone understands. Paul understands what I'm putting down there.
Yeah.
So,
Yeah.
no, that was a great story. I love that you shared that on LinkedIn, but what's your thoughts? Like, what's an acceptable as you've gone through this, with different clients and throughout your experience, people always ask me, "What's the benchmark? Like, what should it be? What's the acceptable payroll range?" I'm like, let's
Yeah.
find out what it is first.
Right. Right.
What's the acceptable payroll range for
You know,
instructors, coaches? What are your thoughts on the
it's
boutique model?
then the boutique model, I would say it's about 35 to 45% of
Yeah,
revenue for instruction
right.
payroll. Right now, there's no overarching KPIs for the fitness industry. Although I saw there's a guy, I think he's based out of Thailand, the Fit Grid,
Oh
or
yeah, yeah,
yeah,
Jack Thomas.
Jack has put together
Yeah.
I think a comprehensive KPIs for the studio industries. And I think that's going to be really kind of game changer in 2026, just because I think people have been looking for this information for a while, and you
They
can
have.
Google it, right? But
Yeah.
depending upon your source, right? Or what's Chat GPT going to tell me?
Yeah,
It
yeah.
hallucinates, right? And so, yeah, so I think 35 to 45% is good. So that range, it really moves depending upon pricing, class utilization, class size, and whether the owner teaches. So 35 to 45%, if you're not paying yourself as the owner for those classes, you're kind of teaching those for free because that's what the owner does, right? So, payroll isn't good or bad. It's really contextual. So let's,
Such a good
like I
point.
said, you can you drill down into what kind of some one of those unit economics that I know you talk about, Albert, in those, class size or utilization. So maybe you have a class that is only generating, 5 people coming to it, and you have space for 30 or 40. Do we need to keep that class necessarily? Maybe, maybe not. And so, it's having those further conversations about.
I love that you were first off, Jack Thomas, such a true gentleman. He is an amazing person. Everything that he's built, including his podcasts, and he's actually going to be on the show. So I'm really looking forward to that. And I had no
Nice,
idea.
nice.
Jack, you didn't tell me anything. I didn't know he was coming up with these benchmarks. I mean, they do a lot of stuff in our space, and so I need to check that out. But he'll be on the show. But I love what you're chatting about the contextual piece. It's almost like, okay, let's dig more. Okay, so you go through your P&L and you find out, like you're doing, Paul, 62% payroll margin. That's raising a red flag. What is going on? Why is it? And before you start just slashing compensation packages and rates and classes, you got to understand like what's working and what's
Hmm.
not, to your point, Paul. And then it's going into what is my capacity? What is my utilization? What is my class rate for each one of those classes? Right? Is this the best performer? Is it not the best performer? There's just so many things that are involved. And that was going to be my next question for you is how you, as you're going through that and you're getting to this discovery mode, how do you get the owners? Because I can only imagine, I just can't have that conversation. I
Right, right.
just can't talk money with my instructors. I thought that was just that beginning interview that first time, and I never had to
Mm,
talk about it again. But how do you
yeah.
coach owners through some of these, through these comp conversations that, yes, they are a little bit uncomfortable. I feel like we're all like that when we talk about money, right?
Yeah, what's the phrase? People get funny with money,
Yeah.
right? And so, yeah, whenever you're talking about compensation, right? Ooh, that's a tricky thing. And really, I lean that, so some of my, what the levers kind of that move that are, talking about schedule design or class
Oh,
utilization or, attendance based comp bands. So
oh,
if you
yeah,
have 5 to 10 people in a class versus, 10 to 20, there's different ways to structure things. And kind of reducing those low demand classes instead of, underpaying strong instructors. So it's like you want to take a look at who are your high performers are
mhm,
in your studio. Who are the people that your clients are raving about that are getting you those, 5-star reviews. Those are the ones those are the gems that you want to keep a hold of, right?
right.
So it's just, but it's, HR conversations are always tricky,
Yeah.
no matter what industry you're in. So
Right.
people don't like to have those difficult conversations, and so they don't have them, which then leads to worse conversations that they need to have when they need to let people
Exactly.
letting people go, because it's like, so
The
because
business
you didn't
failed.
address it at the start, now we have to have other conversations. And so um
Oh
so,
man,
so
this
it's, you know,
reminds me. This is like early career trauma. I remember being, what is that place called down in I think it's in Orange County. It's Board and Brew for those that know
okay.
California. Amazing sandwiches, really good spot. I couldn't wait. I was having lunch with a mentor. I'm like, Board and Brew. I'm like, yes. Like, too bad we're not gonna have a beer, but maybe later I'll come back. But great sandwiches. Anyways, he kicks off the conversation by saying, Albert, quit being fucking selfish. And sorry, I had to whisper that. Like I'm gonna get in trouble on the show. But quit being effing, I don't cuss a lot. Quit being effing selfish. And I remember just a nice gut punch. And I didn't understand where this was coming from. And he said, you are so worried about your having these types of conversations that are uncomfortable because you're insecure about it and you don't feel great yet. On the other side of the table, someone that needs your coaching, your mentorship, your development, your decision making, your leadership. And if you don't, they don't know, the business goes on without you making any changes, course correcting, and it unravels from there, just a death by paper cut. And till this day, while these uncomfortable conversations still exist, having a tough one, having a calm conversation or what have you, I remember that conversation like, man, I can't put myself, my insecurities, my emotional state ahead of the greater good, right? Or that
Right.
team member that needs my leadership. And so you just
Hmm.
reminded me of that. And this was, by the way, this was like 15 years ago. It still haunts me. I'm like, all I wanted was a sandwich and beer, man.
Right. Right.
Yeah, but no, it was such a good learning lesson. And this kind of applies here is you have 62% of your payroll, you need to make a decision. And yes, hard and uncomfortable, but you need to go discover more. And once you discovered, yeah, you need to make, I mean, that's what we signed up
Yeah.
for, right? To be a business owner. That's the
Hmm.
messiness that I like chatting about on these shows is it's not always rainbows and butterflies or absentee ownership and leadership got to be involved. And sometimes it it means making some of the tough calls
It
too.
does. It does. Yeah. Leadership, I mean, it's those many hats people wear. It's like it's
Yeah.
the owner hats, the HR hats, the finance hat. It's the, you know, the instructor hats, the cleaner hat. It's like, okay,
Mm.
so I gotta put on my HR hat today to have that conversation. That
I hate that hat.
yeah, it's like, oh, I don't want to wear that hat. Can we
Yeah.
give it to somebody else?
Here, can you wear this for me?
Right,
Hey,
right, yeah. So yeah,
spouse.
and you know, right. It's been used. I've been worked out on it, but hey, you know, so and kind of, you know, how do I guide people through those conversations? So we anchor really in sustainability, not
Mm,
not blaming. So really, kind of, you can set that boundary with, hey, the structure protects the studio long term, and that lands very differently than we just need to cut costs.
right.
And so getting back to that clarity, which
Mhm.
builds the trust. So it's all about getting clarity on your numbers, on your people, just the whole business, right? And so
Well, and I love that you don't just talk about revenue, right? You talk about profit, and this dog's gonna keep barking right in front of my office. I mean, we're keeping it raw and real. This dog, because
right.
my kids went out to play in the park, and of course she's gonna lose her mind. Anyways,
Of course,
I'll edit out.
I've
Maybe I
got a
won't edit it. We'll see.
I've got a 60-pound poodle, which he's behaving right now. So he's with the rest of the family. So
Nope. See, you got good dogs. I have dogs, man. Anyways, I have a whole nother story. Speaking of just blowing money, yeah, I have a whole story for that. Anyway, so you talk a lot about revenue, but more often you talk about profit and protecting profit. And I loved your framework that you've posted about. It's actually really simple. It's revenue, profit margin, client retention, average revenue per client. Some say ARPU, but I like that you say client or member, average revenue per client, per member, per user, owner pay consistency, like you were mentioning earlier. So why did you choose those fives? Did you feel like those have the biggest weight when it comes to actually operating the business profitably?
yeah, yeah, I did, and they show behavior. Not they're not vanity metrics. So
Love that.
so many people look at how many clients I have, or what's the size of my studio, or
Yeah.
you know, it's like, okay, that's nice, but are those clients paying to, you know, keep your lights on? Are they,
Yeah.
is it paying? Is it enough to, where you can, take a 2-week vacation without the studio burning down? If not, that's nice. I'm so bad you have those. So yeah, so revenue, kind of, so why those 5 numbers? So revenue shows demand, margin shows efficiency, retention shows value. So that value, like
Experience.
we talked about the lifetime value, it's easier to retain or more profitable to retain a current client than it is to go out and get a new one. It's because, as we know, getting clients is tough. And so,
Yeah.
especially in this
Placement
industry
sale.
where these gyms that are studios that are competing against each other,
And if
average
you don't
revenue.
mind,
Yeah.
I want to stop because that's so important, so timely, especially as we cross into 26 when it's going to be the year of retention. I'm going to keep saying that. And I love that you brought this up and it's around experience. Any businesses and those listening, you're probably doing the same where you're reducing your square footage, or maybe you just got into something you reduce the square footage versus the standard model, which means you probably need less members to cover occupancy costs and things like that. However, if one of those, let's say 200 or 300 members leave, it's a big chunk, right? Versus if you had 8,000, 9,000 members, one leaves. All right, well, we live to see another day. Out of 2 to 300, I mean, that's massive. That's massive to your bottom line when you think of dues and the dues flow through. So, Paul, I love that you talk about retention, your existing client base, retaining them, focusing on that LTV, right? That's huge. Sorry, you were going to go into the
Yeah.
shared wallet as well.
Yeah. So yeah, average revenue per client shows that depth, right?
Mm.
How much you're making per client, and then owner pay consistency shows stability. Are you able to pay yourself consistently every month, right? And it doesn't have to be, when you're starting out, not a huge amount, but getting in the habit of setting aside that money for you, every month. I'm going to pay myself $500 this month, right? Better than I was the previous month. And also likes and followers, they don't pay the rent. I
Mhm.
mean, they don't. We're not insta famous, right? And so I'm not making my money on Instagram. And so it's like, I
No,
don't know.
I get killed by the marketing people again. Here we go.
We
Blame
are.
Paul. Paul, go
So
after Paul this time. Yeah, I'm still
it's
bruised
the
up.
agencies. The agencies are going after us, right? And so
Well, let's deep dive into retention, right? So retention and something else you chat about is just frequency of visits. And so if you find as you're doing your discovery with the client that those are dropping, man, my retention is not strong and the frequency of visits is dropping. My power users are who knows where, right? They said vacation, but it's been like 3 months now. Where are they? What do you think owners need to do operationally when they start to see some of that churn, that attrition creep up?
yeah, so I would say, audit the schedule stability. Looking at the schedule, looking at capacity, looking at how many people are going to each class. Identifying those customers who, like you said, have been on vacation for a while and who haven't come, but that might still be there might still be on that MRR, right? And so that monthly recurring revenue. It's like, okay, so but then if they're in the gym, they're buying additional add-ons, right? But if they're just paying that fee, like, okay, you're not getting that extra revenue. You want to review your instructor consistency. Are the instructor coming to teaching all their classes? Are they having a lot of dropouts? Fix onboarding
Mm,
before you fix your marketing, right? So if you have a crappy onboarding process, no amount of marketing's gonna be able to replace that churn that you're getting. People come in for that intro offer. If you're not converting those intro offers into actual clients, something's going on with your onboarding process. And so I'm not an ops guy, so not having worked actually in a gym, but I've seen it a lot of times at the university. Is like when we hire staff and we do a crappy job of onboarding, we're searching for a new staff member in 3 months. So that's expensive, not only because of the time
super
you and
expensive.
effort you put into training them, but all that knowledge or lost time that you could have been doing other things. And so retention problems rarely start with ads. So
Yeah, such a good point. I know you mentioned you've never been an operator, but I'm telling you, you're spot on. Having been an operator, I wish I had you in my corner. Seriously. And walk me through thoughts on any best practices on how to improve that average revenue per client. There's the route of, yeah, we can just raise prices, right? Whether that's
yeah.
per session or per membership tier. Anything else on how to lift that up?
Yeah, so you can improve your packaging. So you could offer group classes plus some semi-privates. So bundling things together, clarifying those tiers of membership. What is it if you have A, B, and C? What do you get? And C is your highest one. What's the differentiation between A, B, and C? So why would somebody want to partake of that? What's the added benefit for them?
Oh, I like you're talking about
And really,
anchoring.
yeah.
Yeah, that's a great strategy. Interesting.
Yeah, and then also increase usage before increasing pricing. So, if you have somebody that's on a twice a week package where they can come in and do two times in the studio, get them to do some, add-ons for that third time or that fourth time a week, rather than just switching them automatically to that 4x or 3x membership, because they might not feel ready to make that switch, though they might make that commitment to that higher packaging. But if you can get that additional revenue from those drop-ins, right? And so really providing more value to the clients first, rather than and then volume comes after that.
So one thing that I've been struggling with, actually, I was just having a recent conversation around owner distribution. And by the way, this was a very rare situation where I felt like the owner was overdrawing from the company,
Mm,
right? In many cases, it's almost like I always get, we haven't even been paying ourselves. I'm like, oh, we got to figure that out. You're putting
right,
blood,
right.
sweat, and tears. But in this case, it was overdrawing. And I was trying to put together a plan where it was a function of revenue. And in this particular business, seasonality was a major one, right? You had some big spikes. And then in certain months of the year, as we all know, in the fitness and wellness space, it's fairly typical in most cases that January through March is or maybe even a little bit of April or heavy months. And then towards the back Q4, typically less so maybe in the wellness, more so in fitness where things start to die off, right? We're all eating versus working out, some of us,
Right.
right?
Yeah.
So what are your thoughts on that where owner distribution is the actual function of, right, the pace of revenue? Well, actually not revenue, the pace of profit. So if we're making less this month, then we should be getting a lower distribution versus something, fixed in a sense. Cause I start to coach owners and then they get a little taste of being paid. I'm like, no, we're good. No, we're going to do this every single month. Like, wait a second. Hold on. We're getting greedy. Yeah. So
Right.
how
Yeah.
do you coach through that?
That's a great point. I mean, I like that they are, taking that salary, that distribution. But if they're doing it at the expense of their profit, right? Yeah, you got to get that corrected. So, and I think it's making sure that they understand that seasonality of their income, right? It's like, hey, we can, take more maybe in January through April, but in Q4 when things aren't going as well, we're gonna have to take less. And so, or what you could do is kind of like a 3-year trend analysis of the revenue and say what it's done, and so kind of come up with a kind of a fixed average. So you're spreading
Right.
that out. So you're
Yeah.
taking less in January through April, but you're taking more than what you would have been able to take in Q4.
So it
So
balances out throughout the
so it
year.
balances out, yeah.
Yeah.
So
I like
kind
that.
of then people make their life decisions on what they're taking out, right? So rather than having those spikes, you just having kind of a flat, and then the next year reevaluate that, right?
So good. I like that. Yeah. You reevaluate it with some type of, maybe a growth percentage, inflation percentage, or
Right.
what have you, right? So the family taken care of or the owner's taken care of. All right. So I
Yeah.
wanted to leave it for last and I want to be respectful of your time, but you talk a lot about my favorite tool, but I swear I can post twice a day on LinkedIn. I could run the owner's seat. I could do my newsletter. And I'm telling you, till this day, 99% of the times I lift up the hood and I ask, do you have a 13-week cash flow forecast? It is an absolute no. What the hell are you talking about? What is that? And so
I don't
I
have a
love
I don't have a 4-week cash
oh,
flow
yeah, I don't have a
forecast.
exactly. I'm like a forecast. So walk me through how I love that you promote this. What do you recommend that's in the 13-week cash flow forecast? What should be included? What can wait? And then any mistakes that you find as you kind of get it rolling, owners maybe
Yeah.
take over, anything that you see that just starts to get back into some old habits?
Yeah, yeah. No, so I love that, we're kind of aligned on, hey, this is kind of how you're going to drive your business. And we can probably have a whole podcast on
We
cash
should.
flow. I don't know how many listeners we would get. I mean, people be like,
The average
they said it
time listening is 1 minute.
right. It's like, they swiped away on that, right? So the simplest 13-week cash flow, starting cash, expected weekly inflows, and then fixed outflows, your payroll dates, and your owner pay. Really, I think that's really enough to put together a cash flow forecast in the simplest of terms. And so, even though it's only five items, those items allow you to lead confidently and
Mhm.
kind of have a better understanding of how your cash comes in and how it goes out. And so, kind of the mistakes that I see, over precision, trying to, time it exactly
Mhm.
right,
Uh-huh.
or ignoring that timing, like we talked about before with the net terms of, the 15, 30, 45, 60. And then also treating it like a budget. It's not a budget. It's so forecasts are
You get that a lot.
directional.
Yeah,
They're not perfect. And so
right.
it's your best guess at what your cash needs are going to be for the upcoming weeks, right? And
Mhm.
so, and then it's a rolling thing, and so it's not, we don't have to be down to the penny on it.
Yeah.
So
No, that's so spot on. And actually, even with some tools, and I like to use AI in this front, you can bring the variances closer, but is it ever going to be perfect? No. And that's not the point. To
no,
your point, Paul, it's directional. It's understanding, is this the right time to spend on this, knowing we
right,
know what's
right,
coming in, or should this be pushed out? Or like you were sharing earlier around some of the deep diving you do around expense management, this may flag and say, hey, you know what? This is an anomaly. We might want to look in here and see how much are we spending in this specific
hmm
category. But I love that. And it's not a
yeah,
budget. There's a budget for that, right? For your
right,
business and all that. The cash flow forecast is
right,
completely different. It's so funny though, and this is not a statement of cash flows, y'all. That's completely different. You have your income, your P&L, your income statement. You have your balance sheet, and you have your statement of cash flows, which typically is putting things in a operating cash, right? Financing cash, and then what am I missing there?
uh,
Investment cash
right, yeah,
forward,
yeah,
right? So I actually like to pool that on a monthly basis compared to 4 weeks worth of a 13-week cash flow, and then going into an AP review, kind of like the activity you were talking about earlier. And now speaking of visibility, now you have full visibility, all angles of where and why your money's going to whatever it's going to.
hmm
But a lot of people aren't doing that because they stick married to, again, the P&L and their checking account, and that is
right,
it. And
yeah,
it's a negligent way to run a business. And I don't say that disrespectfully, right? It's just you don't know what you don't know. So for those
yeah,
listening, Paul just went over not only his framework, which is outstanding when it comes to profitability, but also a basic 13-week cash flow that you can do and pull it up weekly, right? And whether it's with a partner or not, it's something that you can go do. Reach out to Paul, reach out to myself. We'll walk you through how to generate that and what to pull from QuickBooks so that you're feeding it into, including your
yeah,
bank feeds as well. But no, I love that you promote this. I think cash flow is everything, king and queen. You mentioned, and I'm like you, I want more businesses to thrive in 26. Here's the reality, and I've said this on a couple episodes now that are coming in the future, that I think there's going to be more private equity in our
mm,
space, in our industry, in fitness and wellness. I'm not anti private equity. I'm actually pro private equity. I think it's awesome that we have all this capital coming into this industry or industries. However, the reality of it is when one of those networks, those portfolios land in your backyard, if you're an independent gym owner, studio owner, what have you, very difficult if you don't have your financials in order. It's very difficult to
right,
compete with. Or if you're in an exit strategy mode, it's like, yes, I want to sell to them. They're going to eat your lunch and get you at a discount if you don't have your ducks in order from a financial back office. And so everything that Paul just went through and that I like to go through in my newsletter or in other episodes on the owner seat, listen to it because there will be a day someone shows up in your backyard and everything that you worked for, it gets a price tag at a fifth of what you thought it was worth. And it's not a good feeling. I've seen it happen. So Paul, I love that you go through the 13-week cash flow to make sure that these businesses survive, but also
yeah.
thrive as well.
Yeah, and kind of building up on what you just said, Albert. If your books aren't in order and the private equity comes in, or even non-private equity, somebody wants to come buy your gym,
Right.
they're going to want to see what your books are for the past 3 years. And if you're not showing a profit, it's hard to say, oh yeah, I spent, X $1 million on this. Where is it in your statements?
Sure.
Oh, and then if you're just also kind of kind of piggybacking off that, one thing I don't like to see is mixing personal and business expenses together.
Yeah.
Make sure you have those separate. I mean, it should be a kind of a self-explanatory thing, but so often people are mixing both, and then when it comes to tax time, it's like, okay, then you're driving your accountant crazy. So
You never want that 3-letter audit coming your way. So make
no,
sure,
let's stay
yeah,
away
let's
from the
yeah,
IRS.
let's stay away. Oh, I don't even say their name anymore. I never know who's listening. I'm just kidding.
They might be listening. Who knows nowadays? I don't know.
Well, good. This was so good. I really appreciate one thing I love about what I get to do here on the owner seat is having people like you on to educate. Cause I think a lot of people, I'm hoping that they heard everything that you just went through because there's so many nuggets in there for them to run a successful, in a long-term, sustainable business the right way. So good. Paul, for those that do want to reach out to you and connect with you, and learn more about your business, and just have, be able to just pick at your brain and get that wealth of knowledge, where can they reach out to you?
That's a great question. I am on Instagram at, let's see, what is my username? I should know that.
Your time.
Paul Roch Fit Money. So PaulRochFitmoney on Instagram. I'm searchable on LinkedIn. Like Albert says, follow me there, connect with me. Happy to reach out to you to talk finances, provide some therapy as well about your business. Just provide a listening ear, right? With no judgment, like I said. I'm could find me at rochaccountingservices.com. And so, I know Albert, you'll link all this in the show notes.
Will do.
But hey, I'm open to do business. Want to work with studio owners and really help people thrive in 2026.
So
Yeah.
good. Now I know you don't spell it this way, but while we were off camera at the start of this, you said it's, and I knew it was Roch, but you told me it's like it's like Scotch, and now that's all I could think about. So we're gonna jump off this. I'm gonna go get a glass of Scotch, Paul, and that's all I could think about. But aside from,
Well, hey, it's psychological, right? It's
yeah,
like,
there you
hey,
go.
okay, hopefully, talking with me doesn't drive you to drink,
Yeah, no,
and
no, it won't. It
so
won't. It's not. It's now just some, a little sip here and there. It'll be nice.
right,
Well,
yeah,
this was so good. So I'll make sure to include that in the show notes. Really
yeah.
appreciate your time. And for those listening, this has been another episode of The Owner Seat. As always, I'm your host, Albert Ramos. Paul, it's such a pleasure to have you on. So many nuggets on here. And for those that, if this is your first time listening, you'll know episodes are dropping now every Monday and Friday at 8 a.m. Central. So you'll make sure to see Paul and some other of our guests. And feel free to subscribe there on YouTube, Spotify, or Apple Podcasts. We're actually on all of the major platforms, and feel free to subscribe if you like it audio while working out, or if you also like to watch. You might have seen some funny things that we did today. So thank you so much, Paul, and thank you to everyone for listening. We'll see you next time.
Awesome.